Welcome to Intelligence Gateway.
Hello. Today we are going to start second module of financial analysis, in which we are going to discuss financial statement analysis. Financial statement analysis. Financial statement analysis refers to the process of examining and evaluating a company's financial statements to gain insights into its financial performance, position, and overall health. It involves analyzing various financial statements, including income statement, balance sheet, and cash flow statement, to assess key financial ratios, trends, and indicators. The goal of financial statement analysis is to understand the company's profitability, liquidity, solvency, efficiency, and other relevant aspects. It helps stakeholders, such as investors, creditors, and managers, make informed decisions regarding investments, creditworthiness, and strategic planning. By interpreting financial statement data, comparing it to industry benchmarks, and identifying trends, financial statement analysis provides a comprehensive view of a company's financial condition and aids in assessing its strengths, weaknesses, and potential risks. Horizontal and vertical analysis of financial statements. Horizontal analysis and vertical analysis are two commonly used techniques in financial statement analysis. Here's a brief explanation of each. Horizontal analysis. Horizontal analysis, also known as trend analysis, involves comparing financial data over multiple periods to identify and analyze changes in financial performance over time. It examines the absolute and percentage changes in line items across financial statements, such as the income statement and balance sheet. Horizontal analysis helps identify trends, patterns, and fluctuations in financial performance, highlighting areas of growth, stability, or potential concerns. By comparing historical data, analysts can assess the company's performance trajectory, identify anomalies, and make informed predictions about future performance. Vertical analysis. Vertical analysis, also referred to as common size analysis, involves expressing financial statement line items as percentages of a base figure. The base figure is typically total revenue for the income statement and total assets for the balance sheet. By converting values into percentages, vertical analysis allows for easier comparison of different components within a financial statement or across multiple companies. It helps identify the relative importance of various line items and their contribution to the overall financial structure. Vertical analysis facilitates the identification of trends in the composition of financial statements, such as changes in expense ratios, asset composition, or debt-to-equity ratios, providing insights into the company's financial structure and highlighting areas of strength or weakness. Both horizontal and vertical analysis are valuable tools for understanding the trends, patterns, and relationships within financial statements. They complement each other and provide different perspectives on a company's financial performance and position. Common-size financial statements. Common-size financial statements are financial statements in which all line items are expressed as a percentage of a base figure. The base figure is typically the total revenue for the income statement and total assets for the balance sheet. By converting the values into percentages, common-size financial statements allow for easier comparison and analysis of different components within a financial statement or across multiple companies. Common-size financial statements provide a standardized format that helps highlight the relative importance of various line items and their contribution to the overall financial structure. This allows for a clearer understanding of the composition and trends within the financial statements. By comparing the percentages, analysts can identify changes in the relative proportions of different items over time or between the percentages. Analysts can identify changes in the relative proportions of different items over time or between companies, which can provide insights into areas of strength or weakness. Common-size financial statements enable meaningful comparisons and analysis as they remove the impact of scale and size differences among companies. This is particularly useful when comparing companies of different sizes or when tracking the changes in a company's financial structure over time. Overall, common-size financial statements enhance the transparency and comparability of financial information, making it easier to identify trends, patterns, and areas of concern or opportunity within a company's financial statements. Ratio analysis, liquidity, solvency, profitability, and efficiency ratios. Ratio analysis involves the calculation and interpretation of various financial ratios to assess different aspects of a company's performance. Here are brief explanations of the key categories of ratios commonly used in ratio analysis. Liquidity ratios. Liquidity ratios measure a company's ability to meet its short-term financial obligations. They assess the availability of liquid assets to cover current liabilities. Common liquidity ratios include the current ratio current assets divided by current liabilities and the quick ratio liquid assets divided by current liabilities. These ratios help determine if a company has sufficient short-term liquidity to pay its bills and handle unexpected expenses. Solvency ratios. Solvency ratios assess a company's long-term financial stability and ability to meet its long-term obligations. These ratios examine the proportion of debt and equity in a company's capital structure. Examples of solvency ratios include the debt-to-equity ratio, total debt divided by total equity, and the interest coverage ratio. Earnings before interest and taxes divided by interest expense. Solvency ratios help evaluate a company's financial leverage and its capacity to repay long-term debts. Profitability ratios. Profitability ratios measure a company's ability to generate earnings and provide insights into its operational efficiency and profitability. Efficiency ratios. Efficiency ratios, also known as activity ratios, evaluate a company's efficiency in managing its resources and assets. They measure how effectively a company utilizes its assets to generate sales and revenue. Examples of efficiency ratios include inventory turnover ratio, costs, goods sold divided by average inventory, accounts receivable turnover ratio, net credit sales divided by average accounts receivable, and asset turnover ratio, revenue divided by average total assets. Efficiency ratios help assess the effectiveness of a company's operations and asset management by analyzing these liquidity, solvency, profitability, and efficiency ratios. Stakeholders can gain valuable insights into a company's financial performance, risk profile, and operational efficiency. These ratios aid in decision-making, benchmarking against industry peers, and identifying areas for improvement. DuPont analysis and return on investment ROI. DuPont analysis is a method used to analyze a company's return on equity ROI by breaking it down into its component parts. It provides a detailed understanding of the factors that drive a company's profitability and efficiency. The DuPont analysis decomposes ROI into three key ratios: profitability, asset turnover, and financial leverage. Here's a breakdown of each component. Profitability. This ratio measures the company's ability to generate profits from its operations. Common profitability ratios used in DuPont analysis include gross profit margin, gross profit divided by revenue, and net profit margin, net income divided by revenue. These ratios indicate how effectively the company manages its costs and generates profits. Asset turnover. This ratio evaluates how efficiently a company utilizes its assets to generate sales. It is calculated by dividing revenue by average total assets. A higher asset turnover ratio indicates better utilization of assets and efficient sales. Generation financial leverage. This ratio assesses the use of debt financing by the company. It is measured using the debt-to-equity ratio, total debt divided by total equity. Higher financial leverage indicates a greater reliance on debt financing by breaking down ROE into these components. DuPont analysis helps identify the drivers behind a company's return on investment and highlights areas that contribute to its overall performance. It provides a more comprehensive understanding of the company's profitability, asset management, and capital structure. Return on investment (ROI) is a financial metric that measures the profitability of an investment. It is typically expressed as a percentage and calculates the return generated relative to the cost of the investment. ROI is calculated by dividing the net profit or gain from the investment by the cost of the investment and multiplying it by 100. ROI is a widely used metric for evaluating the profitability and efficiency of investments. It helps assess the financial viability of a project or investment by comparing the return to the initial investment cost. ROI enables investors and managers to make informed decisions by evaluating the potential returns and risks associated with different investment opportunities. A higher ROI indicates a more profitable investment, while a lower ROI suggests lower returns or potential losses. Evaluating company performance and benchmarking. Evaluating company performance and benchmarking involves assessing a company's financial and operational metrics in comparison to industry peers or established benchmarks. It provides valuable insights into a company's competitiveness, efficiency, and overall performance. Here are some key aspects to consider. Financial performance. Evaluate financial indicators, such as revenue growth, profitability ratios, e.g., net profit margin, return on investment (ROI), return on equity (ROE), and cash flow metrics. Compare these metrics to industry averages or competitors to determine if the company is performing well relative to its peers. Operational efficiency. Assess operational metrics such as inventory turnover, asset turnover, and accounts receivable turnover. These ratios help evaluate how efficiently a company is utilizing its resources and managing its operations. Benchmarking against industry leaders or best practices can highlight areas where improvements can be made. Market position. Consider market share, customer satisfaction, and brand recognition to gauge the company's competitive position. Compare these factors to industry benchmarks or competitors to determine if the company is gaining or losing market share. Key performance indicators (KPIs). Identify and track relevant KPIs specific to the industry or company's objectives. These could include metrics related to sales growth, customer acquisition and retention, product quality, or employee productivity. Benchmarking these KPIs against industry peers can provide insights into the company's performance and identify areas for improvement. Qualitative factors. In addition to financial and operational metrics, consider qualitative factors such as innovation, management team expertise, and corporate culture. These factors can influence a company's long-term success and competitive advantage. While not easily quantifiable, they contribute to overall performance and should be considered in the evaluation and benchmarking process. Benchmarking against industry peers or best practices provides context for evaluating a company's performance. It helps identify areas where a company excels and areas where improvements can be made by comparing key metrics and analyzing performance against benchmarks. Companies can set goals, develop strategies, and make informed decisions to enhance their performance and maintain a competitive edge in the market.
Thanks for watching. For more information, like, comment, and subscribe our channel.